Hey, everyone.
Hey, it's showtime.
It's showtime. And now that I know what it means, we're at the same bat channel.
And bat time.
And bat time. Okay. You threw me for a loop last week. I was like, what is he talking about? I don't know what that means. Well, hello, everyone, and happy Tuesday. Been a good Tuesday for you guys, I hope. Has it been a good Tuesday for you?
It's been decent. It's been pretty good.
I'm pretty sure I saw you just in front of your computer all day long. That's about like your day. Just a lot of research.
Catch up.
Yeah. Had a good closing yesterday. And then a lot more research for clients today. So how is everybody's Tuesday? Say hello, say howdy, pop on the chat and tell us how you doing. Quick question we were talking about before we started here was we were asking each other, do you think that you are unable to buy out of the market, that you're priced out of the market? We wondered, answer us in the chat, tell us what you think, whether or not you are priced out of the market. That was something that we thought about today. We were just talking about that. Are you priced out of the market?
Is it harder now than compared to say 10 years ago?
Yeah. For us, we bought our first house like 30 years ago, I think, over 30 years ago. And I can say that it was definitely more affordable then. I think for, and even adjusted for inflation, you could tell it was not.
And, some of it's area.
Yeah, but, a lot of it.
I mean, there are definitely some areas that
all right, I see
price and stuff more than others.
I see you guys popping on. Pop on and say hello. Drop me a comment and tell me hello. I see some of you joining on. Want to say hello. Okay, I have a fun poll that has to do with what the heck's going on in the housing market. Okay, which, by the way, we're your hosts. I'm Wendy, and this is Dale, husband of 33 years. We own the brokerage On Track Realty.
Hey, Rhonda.
Hey, and it's Rhonda popping in to say hello. Hey, Rhonda, howdy. Where are all of our other friends, all of our regular viewers? Come and join us, hop online. But okay, I've got a poll that relates to, and I want to hear you guys' answer, okay? You guys have to answer me this. Hang on just a second here. Let me get it started. This is a fun one, okay? Gonna take a quick poll, okay? You guys ready? All right, I want to know some answers. Okay, I want you to tell me which one of these best describes the housing market, okay? I'm gonna give you 3 choices. Which one best describes the housing market? Okay, and if you agree with A, put A in the comments, okay? The market's playing a game of freeze tag and everyone's it. What do you think? Yes, no, yes? Okay. Let's try. That's A. Let's take
I can see, I'm sure there's some sellers and some buyers that might think that, yeah.
Yeah. So you guys tell me what you think about A. Is it true from your experience from wherever you're coming from?
Yeah.
Is it true? All right, let's take a look at B. Here we go. That's great. If the market were a dating app, buyers and sellers have both swiped left and now we're just awkwardly staring at each other. What do you think? That was a good one as well. Who all agrees with this one? Okay, let me see your answer in the chat. A or B? Okay, which one will it be?
Just like the first one, actually, really.
Very similar. Okay, let's take a look at C. All right, this one is similar as to. Imagine a chess game where neither side makes a move for 6 months. Welcome to the housing market. All right, guys, come on, pop in here and tell me.
I can definitely think that sellers really feel that now. So I mean, there's some buyers. We've been able to help buyers find, navigate, find the right places. But I don't know. Actually, I guess we've had some buyers that are just like, okay, they're looking at it like, holy cow, and so I guess it's a little bit of the same. Yeah.
All right, NP, tell me you put
which one? C.
Okay.
Rhonda said C.
Rhonda put C. Okay. Yep, I can definitely see that. Imagine a chess game where neither side makes a move for 6 months. That's about right. I've seen other people say, that it's just like the housing market is frozen. Okay, and Jalen. Hi, Jalen. All the above. Okay, that answer works too. I mean, I don't see that as a D, but that works.
That's pretty.
That works. Okay,
Isn't that always the right answer in the
all
test?
of the above? Yeah, that's true. So
Okay,
there you go.
the trick ones.
All right, guys, the rest of you, pop in here and tell me your answer. The market's playing a game of freeze tag, and everyone is it. Oh, I love this. Is great. In college, the rule for tests was when in doubt, pick C. I love it. It's great. Okay, then it must be C. Imagine a chess game. All right, let's see what Taya has to say. A, okay, market's playing a game of freeze tag, and everyone's it. Yes, very true. Mr. OL popped on to say hello, good evening. Well, hey, how are you? And you also said, how much correction can we expect to the 75070 zip code?
July 2024 was the median sales price was at 590, and now it's at 483,500. So it's a negative 18%.
Wow, is that Salina? Is that where we are? Because that sounds a lot like what we've been seeing for Salina. And I think the big question is how much correction can we still expect, right? 75070 zip code. All right. McKinney. That's right. You were asking about McKinney as well. McKinney, Jalen. Yes. McKinney. Okay. So that's interesting. That particular subset of McKinney. McKinney as a whole is not correcting to that degree.
Because there's parts of McKinney, that whole area over there, that are like up by quite a bit. Too. So, I mean, mostly that's a little bit down, but so you have two dichotomies there. One's really low. Most of it's kind of in the middle. And then there's one area I have to look at my zip codes, because I have a client that's looking in that area by zip codes, and one of the zip codes is up by quite a bit. So,
all right, NP. That is zone to Frisco ISD. Excellent. Oh my goodness, that's an excellent opportunity. I always like it anytime I can see a suburb that has the lower prices but still zoned to the A+ school.
Oh yeah, I see that.
So
now.
that is that could be an excellent opportunity. NP. That's a very strategic move on your part. Color me impressed. I'm very impressed. I really am. I mean, that's exactly the way I would think. Oh, whatever.
Chartreuse.
Something like that. Let's see. Let me see if I missed any comments here. Jalen says, good evening. Not good morning, good evening. And I hope I'm saying your name right. Jalen is how I'm pronouncing it. And then we have, Ty saying it's A. Market's playing a game of freeze tag and everyone is it. All right. Chewy says it's C. So far, no one has voted for B. Yeah, nobody likes B.
No one likes the middle one.
Okay, yeah, I guess not. Okay, Purple Drink has come to see us. Hi, Purple Drink. Hello, Wendy and Dale. Hello to you too. Jalen McKinney, and then we've got our zip code. All right, very good. Well, guys, today want to talk to you about affordability. Probably many of you have felt frustrated by the market, but we're going to actually look at the numbers today to kind of help you, I guess, make sense of what we're seeing. And as we're going through this article, feel free to make some comments, post if you have any questions about it. Love to hear your feedback as we go. Okay, another question here from Jalen. Yes, you are naming the name perfectly correct. Excellent. Excellent. Thank you so much. I'm so glad to hear that. And then NP, question is, how much more correction can we expect to 75070? There's markers, and I talked about this in one of my videos. There's markers that we can watch for when we can tell, because it's not going to bottom out in one day, like next Tuesday. It's not going to bottom out like that. Instead, you want to look for changes in the markers, like your pending sales. Are your pending sales going up instead of down? Do you have less, negative pending sales? Is it going up?
Pending sales are going down since May.
Okay, so we would want to see pending sales improving. We'd want to see more houses going under contract, right? Another indicator is when we see less inventory, right? When we see less months supply. Basically, we're looking for absorption. We're wanting to see that buyers are beginning to equalize with the sellers.
Month supply is up, actually. So
okay, so month supply is up by 35%.
Almost 6 months.
Mm-hmm. Now, to the extent that we can't control the timeline, we do know that it can change pretty quickly if we see a drastic change in affordability, which is what we're talking about today, coincidentally. But if we see, for example, a huge drop in interest rates, we can see the market shift pretty quickly. Yeah.
Rates, changes in rates here around here can make a big difference. Actually, we've kind of become in a pretty good So we're I think an average for an FHA about 6.6% right now, and so we were almost 7% just less than a month ago. And it's actually made some pretty good differences. And the one thing you have to remember, one thing that it's a huge thing, 1% change and 1% decrease in a rate will make the same difference in your monthly payment as 11% decrease in the purchase price and the sales price. So so you're not seeing, very few places are already seeing 11% decrease in price. There are a few, but but you can see,
there are definitely some,
but you can see a 1% decrease in rate. I mean, in a rate.
Right.
So
buy
down or.
That's going to make a big difference. It'll make a big change. I've got a slide even that shows how affordability shifts when we talk about that. Okay, this is a good question. NP says, can we expect a huge drop in mortgage rates? Let me just get out my crystal ball here. I think that by May, to me, the writing's kind of on the wall. If we're looking at constants, like non-variables, we know that President Trump is not, he's not happy with where rates are right now. And I think we can kind of see when Jay Powell's term expires, to me, that's kind of a fixed event where we're going to see rates go down.
And we have the possibility of another decrease in September. I mean, it's kind of a thing that happens sometimes. And that is when the next meeting is with the Fed. So there's a possibility, but for the last 2 years, we watch a lot of different people who predict all this stuff, and most of them have been wrong. So it's all over the place right now. So
I did. And NP is right. I did make a video on the mortgage rates. Mr. OL says, when you say the market can change quickly, what exactly is the timeline? I would say within a month. Within a month. In fact, last year.
At least a half, with the,
and I might be able to show this to you guys as well. What this looks like, what it looked like last year. So let me see if I can see if you guys can see this. Let me see here. Where are we? Okay, I'm going to go right here. Okay. This right here is an example of what we would typically see with seasonality. January, we go up and then we go down. But last year, this is what you saw that was unusual. This period of time was when you could get an FHA mortgage for 5.5%, right? And so that's what we saw. So typically, right, what are we going to see? January, then we go up, then we go down, right? Your typical seasonal pattern. And then you go back up again.
Start of the spring,
Right. And you can see this pattern. I mean, goodness, I could go out to 10 years and you're still going to see that pattern.
To show this is almost exactly the same for years and years.
We always see this sort of mountain, if you will, of seasonality. And then last year it didn't work that way last year, and it's because we saw rates change.
That and go back to right there. 2022. From
you really saw it
made
pronounced
a huge
there.
Difference, and it's been weird ever since. So
it really has. I mean, this was when rates went up so fast. So this was a much more pronounced. But so in answer to your question, if you look at just that one little piece, you can see that made a huge difference within a month. As soon as those rates, and it's because there's so much pent up demand. We saw prices go up when they should have been going down. So in terms of how quickly it can happen within a month, I was talking with a buyer today. We had a Google Meet, and I was talking about how also the builders are not your friends. They are very cutthroat, and it is all business. Nice, I'm not saying they're not nice. I'm just saying that it's all business for them. So the minute they sense that the market is turning around, the
prices are going to go up.
Prices are going to go up. The rate incentives are going to be gone. Okay. So when it's in other words, it's not like they're going to have compassion for you and say, well, let me just give you that rate incentive anyway. So as soon, and they watch very closely.
Incentives go away, prices go up.
Like in that small pocket of time, like October and November, they were raising prices very quickly, and all of the rate incentives were going. In fact, we had a buyer during that time that said, when he'd been watching a particular, he was going to buy with William Ryan Homes, I think. And during that time, he was going to do a new build. He was waiting for a phase to be released. And William Ryan Homes doubled the price of the lot premium during that pocket in time. That's how confident they became. So it can change quickly based on rate activity, and then builders accommodate very quickly, right? All of the forward commitments that they offer are short term, right? They expire within a fairly short period of time, and then they just boom, they quit offering them. So all the goodness that you see, with these nice forward commitments, the minutes we see any kind of strengthening in market demand, they evaporate very quickly. Okay, let's see here now. Yes, NP, I did make a video among 400 others. I was looking at it the other day. I think I'm like up to 470 videos. Like, I have a gift for gab. I agree that rates will come down after Powell leaves, but how much is the question?
Huge question. Yeah.
That is a great question.
So there are so many other things, and it's definitely the Fed is not the main. The Fed rate is not the main effect of
very true. Yeah.
Rate, so,
yeah. And I think we try to talk about that a lot, because I was misunderstood once. Somebody commented, "I'm disappointed in you, Wendy. I thought you knew better." And I was like, okay, I'm sorry for that. So both of us try to clarify. We're not saying that mortgage rates and the Fed rates are the same. We're not saying that at all. So, you made a video on creating scarcity. Yes. And that's that one where President Trump said that he will not issue any long-term
treasuries. Yeah.
And so that can affect it as well.
And it's kind of been more that way. I mean, most of the debt stuff that they've been paying off has been on short-term yield. So short-term treasuries.
So that is going to affect it when there's a scarcity in the long-term bonds. Okay. Yields. Yes, absolutely.
However, what's kind of setting that off going back right now is that things being up and down so much that the investors are still leaning a little bit more towards longer term yield because of how they feel more comfortable with that right now. So it hasn't affected it yet. So
very true. Yeah. This is a fun comment. WEF clause Satan's Schwab. You will own nothing and be happy. My goodness. Not while I'm here. No, I'm just kidding. No, I definitely do not espouse to that, but I've definitely heard people say that. All right. Keep the videos coming. They're great and extremely helpful and insightful. That just makes my day. Thank you so much for saying that.
She's pretty amazing.
I really enjoy it. I'm very passionate about research. I love research in general, and I love turning it into videos. So really, that just makes my day. Puts a smile on my face. Thank you so much for saying that. But I'll talk from. Yeah. Gotcha. Yeah. Okay. Let's see. Hey, Chewy. Chewy, am I saying that right? Chewy.
Sounds
if
right.
Not, let me know.
Like the restaurant?
Yeah, like the restaurant. No, maybe he owns the restaurant. So there you go. In the market for a new house, and fiber internet is very important for me. Okay, we've had buyers that have said that. Is there a way to find the neighborhoods that have fiber internet? That is a great question. I don't want to check every house individually.
You don't have to check every house. You just check the community. But I will tell you that right now in the Dallas-Fort Worth area, AT&T is pretty much putting fiber in every new community, and they're actually going back and trying to fix and trying to do that in some old communities too. So they're on the competition. Since Verizon kind of slowed down, they sold that to Frontier, and then they've taken it back, and so it's pretty good competition. So yeah, I think it's there. So I will.
That is a very interesting question.
So what I usually do. So what I have buyers that. There's an email I send to buyer clients that are buying in different communities. A few weeks before closing, that kind of goes through property taxes and utilities and the HOA, all that stuff, and then services also like that. So, and I usually just look up. I try to do a research on what is being provided in that community. For new construction is usually pretty easy. Master plan communities, they usually have a good setup for what's going to go in there. And you can tell which it's either going to be, for the most part, AT&T is almost always in there. Comcast is the next, Spectrum is the next one that's in there usually.
Spectrum's what we have, I believe. Yeah.
So.
All right. I think it's a really good question. So I think you could find that out in advance, but I hear what you're saying, Chewy. I would get a realtor.
Yeah, you can find out.
Get a realtor who'll do that heavy lifting for you.
Yeah.
He just said he'll do it. He volunteered. All right. But I'll talk no action from Trump admin. If they want, they can move mountains just like they did during COVID that's true, by printing $7 trillion in money. They do not want to reduce the rates.
Okay, you know what that does though?
Ooh,
If as soon as you do it, that will make inflation go up tremendously.
Yeah,
and it is a lag effect, but it will make, and that's what true inflation is: more money than what is being spent. So yeah,
very true.
Yes.
All right. Yes, like the restaurant. I love it. We nailed it.
It's a good restaurant too.
It is a good restaurant. Okay. Speaking of internet, what is the good internet in the McKinney and South Salina area? I'd like to avoid AT&T. I love all this interest that I'm getting in. I love this interest that we're getting in McKinney. Fortunately,
that's probably going to be your. Actually, I will tell you, they are probably the best deal for gigabit plus fiber speed right now. AT&T, but yeah, I'd have to look again. That was not too long ago. I looked it up. That was about the best deal. So we'll see.
Okay, interesting. All right, let's take a look at our article. All right, that is not our article. Hang on, let me find it. Let's see. Here we are. Share this tab instead. There we go. Okay, so we talked about our A's and our B's and our C's. Feel free to keep voting. All right, but let's go ahead and take a look at our article. Here we go. Housing affordability crisis, buying a home now versus 25 years ago. I thought this was a really interesting article, and I was doing the math and I was looking, I was like, okay, in 2000. So poll here. Do you remember when we bought our first house? What year?
Ooh, our first would have been like 93.
Yep. Yeah. You guys, we bought our first house in 1993. We got married in 92, bought our first house by 93. So that tells you how different affordability was back then, right? That we didn't have to save for years and years and years. Of course, we were VA. We were able to get a VA loan.
Yeah, and we worked with an individual investor, and so we were.
It was a for sale by owner. That's true. Who was willing to pay the closing costs, but yeah, so we were not even married a year.
Definitely was not a seller's market then. I don't know if it was actually a buyer's market, but it definitely was not a seller's market then.
Yeah, that is true, because that house had sat for a while. Yeah. You guys don't even want to know the price we paid for it. You would just be so jealous. Okay. All right. Housing affordability crisis. Buying a home now versus 25.
Is a pretty good size backyard.
It was a very nice size backyard. Had a little bit of problems with crime in that neighborhood. It was a low budget house.
Off and on. We were okay, but not too bad.
Okay, clearly we're talking about it.
We were on the edge.
We were on the edge.
Move on.
No, so the neighborhood that we bought in was Arlington, and it was East Arlington, and I'm telling you, gang graffiti was a thing, all right, in our neighborhood. So that wasn't the best of neighborhoods, but we bought it for $54,000. So we were qualified for $74,000, but we wanted to be able to put money in savings every month. So it was really, really important to us. We've always felt that way. Buy under your means. Doesn't matter what they qualify you for. Buy less than that and keep putting money in savings. I'll get off that platform now, but that's what we did. A few more comments. Let's go ahead and pop on these and then we'll go look. Because of money printing during COVID, $400,000 houses become $800,000.
And it's not just money printing. Anytime you do any kind of short-term fixes from the government, it helps somebody real close, we're in a short term, but in general, it makes everything much more price costly in the long term.
I think there's a lot of truth to that. And I feel that way about the Fed a little bit too. Way back in
history, you can see that too.
Yeah, I just feel like that with the Fed. I just kind of wish they would just find like a neutral posture. But I feel like they've been a lot of the reason for why we have an affordability problem. Because, when interest rates were at 7 and 8% consistently, prices were good. That was 1993.
Actually, if you look historically, our rates are still low overall historically. So that's not the issue, really.
Yeah. Okay, here we go. Those who got lucky, they locked their rates at 2%. Yeah. And the luckier ones today get to assume that if they are HOA, if they're FHA loans. By under your means, that's a good point. The temptation is certainly there to spend up to the pre-approval amount. It sure is. And unfortunately, I've literally worked with buyers who didn't feel comfortable telling me what they were qualified for because they were
afraid they were
afraid that we would push them that way. And I just think that, we talked last week about, raising the bar in real estate. And
that's why when you talk to your lender, any lender, not just your lender, but any lender, and talk to multiple lenders, tell them where you want to be. So
yeah, absolutely. Don't ever work with a realtor who pressures you, guys. We have to raise the bar here. It's inexcusable.
Yeah.
They are supposed to represent your best interests. Okay, so many houses for sale in DFW. You're right, Mark. There's a lot out there right now. In fact, Mark, this you might find this. I'm sorry, and I know we haven't gotten to the article yet. This is a fun conversation. I just finished a video on the market crash. I'm spotlighting some communities in Salina and Melissa. Two communities that have had a pretty significant decline in values. I'll put it that way. Did you know, fun fact, back in 2021, the month supply for Salina, okay, you ready? In Salina.
And where? What time?
Oh, 2021. Sorry. Okay. In 2021 was 0.6.
Yeah, it was like really
0.6 months supply. You talk about houses on the market. Okay, it was 0.6 months supply in 2021. Now, 2025, here we are. In Salina, it's 7.5 months. Yeah. So we've gone from 0.6 months supply to 7.5 months supply. So anybody that feels that interest rates don't make a difference, I mean, that just really speaks very loudly to that. And then you have, of course, your builders who are doing all of their, overbuilding. But yes, you are so right, Mark. So many houses for sale in DFW. That's definitely true. Okay, now maybe
moving on.
So maybe we'll make it past the second page. For generations, owning a home has been a key part of the American dream. But with mortgage rates at 20-year highs and home prices sitting at record highs, that dream for many is becoming a nightmare. I agree. I think so. I would say that I agree with that. In 2000, the median home price, wow, guys. In 2000, the median home price was $119,730.
So, but where?
Nationally? Well, if you look at the beginning part, it just says they collected data on mortgage rates, home prices, and it's just all over the United States. And then they have different color codings for less affordable. And so I think this is like an average of what they're talking about. So in 2000, so it's probably like the entire United States, what they're talking about here. In 2000, the median home price was $119,730. Today, that number is $356,000. Okay, which means homes cost 197% more in 2025 as they did in 2000. I mean, guys, that is just mind-boggling. 197% more. In that same time, okay, and this is where you start to see why we have a problem. The median household income increased too, but it only rose by 40%. From 70,000 to 97,800.
So that's an average. That can range. Averages. Which is that? It'd be neat. Oh, so that says median. So that's in the middle. So
right.
Yeah. Okay.
With housing prices severely outpacing income, the gap in home affordability.
I'm just saying because there are definitely some areas of industries that the income went up quite a bit. So it just depends.
Yeah, I think so. I think this probably is national.
Yeah.
And, I was thinking when it was talking about the median price in 2000, and I was thinking that about that time we bought our second home and it was 127,000. So that's dead on. Okay. Let's see here now. With housing prices severely outpacing income, the gap in home affordability grows even larger. I mean, it wouldn't be that big of a deal if home prices happened to go up that much and income went up that much. But the problem is it didn't at all. Okay, we took a look at how income, home values, and mortgage rates have changed over the last 25 years to analyze home affordability and answer two key questions. How much harder is buying a home today than it was 25 years ago? All right. And is there any hope that the current housing crisis will come to an end and restore the American dream?
So what I would like to know, and this, I'll have to look this up, is, okay, has this changed the number of people or number of homeowners? Has the number of homeowners decreased?
Right.
Or has it stayed pretty close the same? Has it been up and down? Because I do know in the last few years, I don't know if it's as far as 5 years, but it's last few years, at the age that the number of new homeowners, younger ones has increased by quite a bit.
Sorry.
So, so maybe that, so I just wondered if that changed, that the older ones have a lot, that's decreased a lot. I don't know. That's a good.
Yeah,
So anyway,
I noticed that the age of the first time home buyer has gotten much older, right? So like when we bought our first house, I was 21, right? So that's definitely true. Okay, let's see where we are. Incomes can't keep up with housing costs. All right, it's easy to think that home prices are what drive home affordability, but what a home costs is only a small piece of the affordability puzzle. You also need to consider median household income and mortgage rate. So these three metrics interplay to determine affordability. Okay, I'm sorry. I gotta put this on Rhonda. Yes, it's the Pink Panther. Sorry, Rhonda. That is a reminder that I have that goes off every evening at that time, and I keep forgetting to disable it on Tuesdays. Yes, the pink. Fun fact, not only that, one time it went off in the middle of Sunday school. So there you go. Much, better on a live stream than in Sunday school, I guess. All right, let's see here now. I got to hide that. Let's go back to our article here. All right. Okay. You also need to consider, the real estate landscape looked dramatically different in 2000 than it does today. So true. The average 30-year mortgage rate sat slightly higher than today's average, between 7 and 8%. That's true. We bought during that time. But homes in the U.S. cost an average of just under $120,000, about a third of what they are today. With similar mortgage rates, that wouldn't mean lower affordability if the median income followed a similar path. So again, that's our problem right there, guys, is that the median income didn't follow that path, but it hasn't. Yes. All right. Household incomes rose by just 40% between 2000 and 2024. At the turn of the century, the median home price was $119, approximately 171% of the median household income. For comparison, in 2024, the median home prices reached $345,000 and some change, which is about 354% of the median income. So we're talking about 171% versus 354%. So that really speaks volumes. And so these are not numbers that we need to adjust for inflation or anything like that. That's just real, real data there. Accounting for the changes in both income and home prices, buying a home today is more than twice as expensive as it was in 2000 in relative terms. And I can tell you this, guys, that we're seeing this with our adult kids. And I know I've said that before. We're seeing that with our adult children, that they're having a hard time entering the housing market because of that. They're starting out on their careers and it's hard for them. They're like, man, housing is expensive. And we're looking over here going, well, I bought when I was 21, right? Completely different world. Let's see where we are now. As home prices increase, now this is another important point as well. The down payment requirements go up proportionately. Higher down payments are also a major barrier for first-time home buyers and play a crucial role in housing affordability. A 20% down payment. Now, this part I really don't so much agree with. A 20% down payment is standard when purchasing a home to avoid private mortgage insurance. Yes to that part, but I wouldn't necessarily say that it's standard. And secure a good mortgage rate.
I guess if they're saying the standard, that's a must if you want to avoid PMI. So you have to do that. But but it's not.
For ease of comparison, that was around 34% of the median household income. So a 20% down payment in 2000 was around 34% of the median household income. Now take a 20% down payment today with a median house price of $355,000 and some change. That would be closer to $71,000, which is just under 73% of the median household. Again, so we're talking about like twice the difference here. For a down payment alone, first-time homebuyers need to save for twice as long to remain competitive and avoid PMI. Again, I would say that, we get a balance of buyers, and I would say we certainly have plenty of buyers that don't have 20% down. Plenty have way more than that. But we get some, that are FHA. We've had a few that have the down payment grant where they didn't have a down payment at all, right? So I wouldn't say that 20% down is a standard. I wouldn't say that at all. Okay, if you can qualify for a mortgage backed by the Federal Housing Administration, FHA, you can put as little as 3.5% down, which would mean a little over $12,500 in today's market. So that's still not chump change there. Unfortunately, a lower down payment means you'll finance more, which drives up your monthly payment and could put your payment to income ratio too high to qualify. All very good points as well. Mortgage rates today are lower. That is true. At the time of this article, it said mortgage rates today average around 7.09% for a 30-year conventional loan. So they're a bit lower than they were at the start of 2000 when they averaged 8.08%.
So how old is this article?
April.
Oh, okay.
Lower mortgage rates always help make homes more affordable, so this is an advantage for home buyers. Speaking of which, here we are. You were talking about this earlier. Here we have today's rates. Okay, so last week when I showed you this chart, I believe last week it was at 6.5 or it was a little bit. Well, it was lower than this.
6.5 something.
Yeah, it was 6.5 something.
6 or 5.7.
Yeah. And so now we're up to 6.6. So we've gone up a little bit just over the past week. Now, let me go ahead and check out a few comments here. We've got some fun comments. I love it when you guys comment. It just makes it so fun. Let's see here now. When I talked about so many houses, Mark says, wow, yeah. Oh, and I didn't even tell you Melissa's stat either. Melissa's was in 2021, it was 0.2 months supply, and now they're up to 6.5 months supply. So such a huge difference there. Chewy, okay, I've been watching 12962 Galaxy Drive Frisco fall for a few months, and I finally went to look at it and found the reason it hasn't sold is that there's a hole in the ceiling. Nice. You're like, oh, what the heck? Buy and fix or steer clear. Depends on what caused it. Depends on if it's a foreclosure. Yeah, it depends on if it's a foreclosure where you don't, or if you don't get a seller's disclosure versus you have a seller's disclosure.
There's a lot of things, you'd have to look at.
Yeah. I mean, honestly, I'd probably buy it. I mean, if I knew exactly what caused it, because okay, no lie, not Chewy, I'm not lying to you. One day we got up, went out into our kitchen, and we had a hole in our ceiling. Do you remember that? There was drywall all over the floor. Yeah. And what had happened was that there was a clog in our AC condenser line, and it had overflowed. And so water had come out. And so, boom, we had a hole in our ceiling.
And actually, so we just recently closed on somebody. They had that before it actually closed, the same thing. Actually, okay, it wasn't actually a clog in the line, but the primary drain line in the AC in the attic wasn't connected well, and it dripped out of that, and it didn't make a hole in the ceiling, but it did you could see visible damage in the sheetrock in the ceiling. So those things do happen. That is probably one of the most regular causes of that. And now this is depending how old this home is. Maybe somebody walked around there and they did a misstep. Who knows?
That could be too.
But I guess it sounds like it's probably maybe being sold as is.
That's what I'm wondering.
Is it vacant? Yeah. I don't know.
And
was it a rental before? Recently. So,
and Chewy, another answer to your question that you're wondering is, have you checked whatever loan you're using? Will it allow there to be a hole in the ceiling?
FHA may not. Yeah. It's hard. They made
So that's a question
on
for your
the
lender.
Edge for them. So yeah.
But I would, if you can get an answer as to why, I wouldn't necessarily steer clear because of that, but I'd want an answer. For example, was the roof bad for years and now you have a mold problem in the attic? Okay, that's more problematic. So,
did it? If that hole in the ceiling is caused by a roof leak, then that's
different. Especially if it was prolonged. So I would say, Chewy, it bears investigation, but not necessarily a hard no.
Yeah.
And I think though for a lot of buyers it would be. And so that's where you kind of can get a little bit of an opportunity, when you can narrow the playing field there. Okay, the Inner Compass. Well, hello. What do you think of the Sutton Fields community in Salina and First Texas Homes? Those are great questions. I think somebody even asked me those questions last week too. Same two communities. I do have some, opinions about both Sutton Fields and Edgewood Creek. I believe you're talking about Edgewood. Well, you might be just talking about First Texas
First
and
Texas
Sutton.
and Sutton Fields,
but First Texas is also right up the street in Edgewood Creek.
There's like 2 or 3 communities right there where First Texas is.
Okay, that is true. They've kind of taken on that area. So Sutton Fields, if schools are really important to you, that's a good reason to buy in Sutton Fields, okay? Because you can get Prosper ISD at a much lower price than you can pretty much anywhere else. However, I'm not a huge fan of Sutton Fields. I don't see values holding super strong there. We've got a lot of lower end builders, and I think First Texas is probably your highest end builder. If you look, for example, at Pacesetter, boy, their Google reviews are almost all 1 and 2 stars. And they've got a presence there in Sutton Fields. You've got like Pacesetter,
so
you've got D.R.
Mattamy.
Horton. Yeah, and I think Mattamy had the better reviews.
Mattamy is a decent home. They're First Texas are nice homes. They just don't tend to come off their prices a lot. And if you're worried about traffic, that Frontier and was it 1357, whatever the north south highway right there, you can wait there for a long time trying to get it there. So it needs a little. Of course, I know they're working on that because they're working on Frontier and they're working on Legacy right there. They're trying to widen those areas, so it'll get better. But
I've heard that from a lot of people. I've had buyers go, well, I was thinking about Sutton Fields, and then I talked to so-and-so who lives there, and now I'm not thinking about Sutton Fields anymore. So they need to do something to change accessibility.
So it's a decent-sized community. It's growing, so
Kind of the same question from Intercompass. I love your channel. Thank you so much. I love hearing that. May I know your take on Sutton Fields? Okay, we've already answered that. All right, Christian Roman. I heard in another video that Texas is insolvent due to the bonds. Texas has a budget surplus, so I'm not sure where you heard that from, but the reason they've been able to lower property taxes and kind of work in that way is because they have a big surplus. It's not necessarily a sustainable surplus. It's more of a one-time thing. But no, I had not heard that. That's interesting. If you feel like it, drop in the chat what video that was. Be interesting to watch that. Mr. OL, I would agree. We purchased our first home in 2008. We're looking to build next year. Current prices are no joke. Yeah, completely agree. Keep in mind, if you do a new build, you're getting today's price at tomorrow's value. So, even though the new builds, you don't get as good of a deal as you do with inventory homes. But if you want to do a new build, I think new builds are terrific, Mr. OL, if you own a home right now and then you got to sell it, right? I think we talked about this last week too, because it allows you to control your timeline so much better. All right, let me jump back in here. Today's mortgage rates. Okay, we're talking about that.
So just real quick on the Texas thing. So there's nothing about the insolvency factor. It's the other way around. And Texas in the world is 9th largest economy. So
not just in the United States, but in the world. So that'd just be interesting, to hear what video that was. Okay. All right, here we go. As we mentioned earlier, mortgage rates are just one part of the equation. And they are. We've got 3 things here. Higher income prices mean larger loan amounts, which can still mean higher monthly payments despite lower annual percentage ratings. For example, with a 30-year conventional loan and a 20% down payment, the monthly mortgage rate in 2000 would have been $708. The number in 2025 sits at $1908, okay, which is 2.7 times higher than it was 25 years ago. Even with a decrease in mortgage rates, okay, so even with those rates coming down, over 25 years, the annual mortgage payment climbed to 12.14% of the median household income to 23.65% in 2025.
I think it would be interesting to see that from a standpoint on the stats of size of houses too, because I do think size of houses have gone up as well.
Yeah, bigger houses. Yeah, that's true. So much more the ranch style in the older, the older homes. So. Very true. All right, let's see here now. It's not all bad news, though, at least when it comes to mortgage rates. There are a variety of incentives available today to help improve housing affordability. Government-backed loans, VA loans, FHA loans, and USDA loans all offer lower down payment requirements which can help bridge that initial gap into home ownership. And guys, there are loan programs beyond those. I mean, they've got what they call census tracking data loans, where if you buy within certain targeted areas, you can get like no PMI. You can do like an FHA loan without the private mortgage insurance. And that is huge to just get rid of that PMI. And when you look at the data census tracking, it's not like, say, high crime areas. It's nothing like that. It's just got some of it's like in really affluent neighborhoods. So I think that is huge right there, just to investigate that as well. So there definitely are. I mean, imagine if you could get rid of that PMI, how huge that would be. All right, let's see here now. Were you going to say something?
I was going to say there is a difference in PMI with FHA or government-backed loans versus conventional loans.
Yeah.
So with conventional, once you become, your LTV is, your loan to value rate is 80%, then you can actually request that to be removed from your mortgage. So with FHA, it's for the life of the loan, and sometimes they actually just well, most of the time you can pay it off up front, or you can finance it. Yeah. So
very true. Very true. Sam had a question here. How about upgrades for quick move-ins? Builders are adding so many upgrades and adding to the price. Are these trustworthy? I would not equate a dollar-to-dollar value with what they say is an upgrade. What I do, Sam, and I've done these with my market analysis because I've encountered this. We were doing a transaction with Grand Homes where they were trying to tell us that at $100,000 in upgrades. And what I did was I took my comparable sales and for my comparable value, and I said, well, actually, these 3 comparable sales all had that upgrade. And so it doesn't count as extra to bring in value. Yeah. So we're only going to consider things that are actually not in my comparable sales. So I don't know if that makes sense, Sam, or not. Had a couple of buyers that I spoke with about a month ago who felt very confident that they were able to figure out the value of the home without a realtor by adding up all the different upgrades and what the builders were saying they were worth. And then I was like, no, that is not how it works at all. You're not going to have, you're in trouble. You're upside down the minute you follow that line of thinking.
Yeah.
Okay.
See, and it really depends on the builder. I mean, so some builders have a higher standard of what their standard that they put out. Grand Homes actually is a lower standard, and then you add a lot of upgrades to it. There are some builders that have a higher, you start with a higher standard, and then you add upgrades on to it. And partly that's by community as well, because some builders will do different things in different communities as well. So it can be all over the place.
So I would not believe them when they add dollar for dollar. They're also very, tactical about how they can kind of change around incentives. I mean, we had a situation once where the builder was like, I'll do this, this, and this price. This was when we were in Florida. And the builder said, I'll do this, this, and this price. I'll give a realtor, bonus commission along with this and this incentive. And we said, okay, it's fine. Buyer said, hey, can we keep the bonus part? We said, okay, that's fine. But they would not agree to our price, right? So then like 2 days later, they came back to us and said, well, actually now we will do this. And they had this whole other line of incentives. They had taken away the realtor bonus. And it sounded better. Okay. But then I did the math side by side. And I told the sales consultant, I said, what you've done here is you've shuffled what you're offering, but your net proceeds is actually higher. Okay. So what you've done essentially is raise the price. Right. And so a lot of times they'll do that. They'll say, I'm adding this in and it's worth this and it's really not worth that. So important to do that breakdown. Hopefully that answered your question, but I would not do a dollar for dollar on that. I'd be like, okay, throw it in. That's fine. I want it for free. That would be my mindset. Okay. Do you think new construction are better than value than existing homes? I'm curious since it would take longer to build equity in newer homes. Interesting thought on that, Taya, is that
always true.
A lot of times the new construction homes are kind of on par with the pre-owned. You're not necessarily having to pay a higher price. So side by side on that. And then also I think the question for me is like, when would they be built? Because when I think of like a 1970s home, they're so prone to have these chronic foundation
It
problems.
depends on the location.
It does depend on the location, but you must admit
Depends
it's
on
pretty
the builder
common.
somewhat, but it was early on in the, because they were just switching over from pier and beam to slab, and but it depends on location. It depends on builders. I mean, some builders are, even some of the older ones are definitely have a much, there's some parts, some communities where I've sold some older homes. They're like $1 million homes, and the quality is amazing.
Yes, that is true.
It's just tremendous. But then there's some new construction ones, and you're having a home built, and the demand's going up, and you're going to get a lot of equity there, and it's really good builders. So I mean, it just depends.
I feel like you can't possibly put those in two camps, because you have so many different builders. You had different builders then, different builders now,
different communities.
Areas. I do know, like your 70s homes, I've seen so many that have the foundation problems, but definitely plenty that didn't. Okay, let's see what Intercompass says. Oh, this is a great question. Which community is a better buy if we're looking for new build, offers great value with good schools? And then she clarifies she's looking on the north side. Intercompass, I really like the strategy.
Price range.
Yeah, and your price range would tell us a lot.
Big difference.
And she said offers great value. I really like the strategy of looking within a lower price community and filtering by A+ schools. Okay, so for example, in Salina, but only look in Prosper ISD, or in McKinney.
McKinney and Prosper ISD.
I'm telling you, McKinney has incredible opportunities for getting into A+ schools. McKinney ISD itself is not as highly rated, but you've got just filter by the schools.
Actually, they have some very top schools that are better than some of the Prosper and Frisco's.
Yeah, they've got like Melissa ISD, they've got Allen ISD. So McKinney's something, and that's kind of not quite as, I'm not sure how far north you're talking, but McKinney you could be considered on that. Okay, let's see what Ty has to say. True, I prefer a home with good bones, but so hard to find one that doesn't have other deferred maintenance issues. That's so true. Do you want to put money into it, or do you want it to be, move-in ready? All right, let me see. I think we're just about done with this article. This talks a little bit about President Trump signing an executive order aimed at addressing the housing affordability crisis. And he did, which was excellent. And this says, whether or not that plan will work remains to be seen, but at least it's a good sign. And it is, that the federal government is aware of. You know what I would love? I would love it if they would do another tax credit. I'm trying to remember what year that was, maybe 2008, 2009, where if you were a first-time home buyer, you got like a $10,000 tax credit on the following year. I'm like, man, I wish they would bring that back, because I think that helped so many first-time buyers to get into a home. I loved that. Okay, let's see here now. Okay, so I was going to show you guys, and this is our last slide. I wanted to show you, this is Housing Affordability Index. And the higher the number, the more affordable we saw the market be. Okay, and so you can see on here that we came from, it was more affordable. And then just this kind of shows that decreasing level of affordability that we saw. And then, over here we see, rates are down. Right. And so we see some pops there. And then, of course, rates went so far up. And then this is kind of where we are now. And if you hear, somebody say, affordability has improved, they're right. It has marginally improved, because you can see, we're going up, and remember, higher is more affordable. And so you can see like it was kind of bottoming out here. And so it has improved some.
But one thing that you can really notice about this is that the affordability since this is beginning of 2011, the affordability, rate has been coming down quite a bit. And then now it's a lot more stable.
Yeah.
Over in the last 2 or 3 years. So,
if you wanted to bring me to a happy place, it would be to get the Fed to put their rates in just a neutral territory that's not restrictive or accommodative.
Don't mess with it.
Stop messing with the housing market, just let the housing market correct itself. Don't restrict, don't accommodate. I think it's just the housing market is so dynamically influenced, by what we see with the Fed. It would be nice to see that be a little more independent.
Let builders build.
And let the market correct itself.
Crazy restrictions and.
Yeah, and I see sometimes when I hear things like President Trump talking about lowering rates to zero, I'm like, oh, that would be so terrible because that would just be so accommodative and just cause prices to go up, and we don't want that either. So I'm very much an advocate of neutral. Yeah. So I mean, if you ask me, I'm an advocate of neutral. And I think that number is hard to quantify exactly. It's more like they can tell after the fact, but that's definitely where I would be a fan. All right, you guys, this has been great. Thank you so much for joining us tonight. Really enjoy our Tuesday nights with you guys. Love it. Look forward to it all week. Yeah, and I love how much you guys commented tonight. Thank you so much. That was
great
awesome.
Comments tonight too.
Yeah. All right. Well, we are going to go from here. Going to go have some dinner, and then we will we'll see you guys next week. All right.
Go out and have a taco.
Yes, exactly. It's Taco Tuesday. All righty. Bye-bye.